Bloomberg Audio Studios.
Podcasts, radio, news.
Fed Chair Jay Powell speaks later today, and that's ahead of Friday's all-important jobs report.
Automakers seeing a run of bad news. Stellantis joins Volkswagen and Aston Martin in issuing the latest profit warnings, partly blaming sluggish demand from China.
And this on M&A Monday, DirecTV and Dish agreed to combine in a deal that will create the biggest pay TV provider in the U.S. All that and more coming up, but let's take a look at where markets are trading 30 minutes until the bells ring. As Matt mentioned, not too great on this Monday. Of course, we're coming off of several consecutive weeks of solid gains, seeing some of the steam come out of the market right now, out of that rally right now. Even with that big run in Chinese equities, you're not seeing that good vibe music over there translate into the U.S. market. The S&P 500 currently down about 0.2%. The NASDAQ 100, your big tech names, which have been leading, currently down about 0.3%. And still a little bit of a sell-off in the bond market right now, Matt. You're not seeing that haven rush necessarily. 10-year yields currently up about 3 basis points.
All right, in terms of the runs that we've seen, Mohammed El-Arian, a Bloomberg opinion columnist and the president of Queen's College, Cambridge, highlighted this chart here on Twitter, showing the S&P 500 has put up its best first 9 months of the year since 1997. The index is up more than 20% year to date, boosted by the 5th consecutive monthly gain in September. The S&P has gained for 10 of the last 11 months. So we've been doing pretty well so far this year.
Making me smarter this Monday morning, Matthew. Let's take a look under the hood as well here. Stellantis plunging after car makers said its forecast for the year would be lower as it plans to lower production. Just taking a beating now. You have Stellantis down more than 12.7%. You have Ford also down 3.2%, 3.3%. It announced that it will install free home chargers for EV buyers as competition heats up in the auto sector. We'll talk more about that later this hour. Also watching shares of EchoStar Corp up about 0.7%. Remember, DirecTV and Dish, which is owned by EchoStar, have agreed to combine in a deal that will create the biggest pay TV provider in the United States. Interesting, Matt, it has been up more than 15% since Bloomberg had reported that the deal would be happening.
Yeah, very interesting. We're going to continue to talk about those mergers, but right now I want to talk about, or rather takeovers. There's no such thing as a merger. Right now I want to talk about what's going on in China. 6 consecutive days of gains there, and they had a bomb today, 9% up on the CSI 300.
Yeah, best run since 2008 or so. It's been pretty amazing to watch the CSI 300. It's now up over 20% year to date. It's in a bull market. You rewind to just a week ago, this index was down by more than 4% or just about. So, I mean, the rate of change here has been just incredible. You're not really seeing it, though, in U.S. equities. And I think a lot of that we can blame on Germany.
I think you also have to ask if it's real or if it's a head fake, because 25%, more than that over a 5-day period. The reality is it's driven by stimulus. The underlying data is weak, as it is in Germany. I think the question is how much of that does that spill over, that weakness abroad, into the United States?
Yeah, Germany having obviously real problems, being the home of 3 automakers, all of whom have their own issues. But really, it's Chinese imports and inflation that are the biggest issue there. We're going to talk about Volkswagen. We're going to talk about BMW. We're going to talk about Daimler, as well as Stellantis, which is kind of like an Italian, Dutch, U.S. automaker, French as well, later on in the program. Right now, I want to focus on the U.S. markets with another chart Mohammed El-Arian highlighted on Twitter this weekend. It shows the strength of everything else, the everything else rally, with the equal-weighted S&P outperforming by the most since 2022. With us now is Morgan Stanley's chief U.S. equity strategist and CIO, Mike Wilson. Regarding the non-farm payrolls number due out this Friday, Wilson says we would need to see an upside surprise to drive a sustainable cyclical rotation in the U.S. And I understand that good news would be good news for some parts of the market, but wouldn't we want to see, in some ways, a miss, because then we could get a bigger cut from the Fed in November?
Well, yeah, maybe it comes with a fine line. I mean, the good news is good news until it's not, because then the Fed has to raise rates too much. That was the story before. Now it's bad news is good until it's too bad. So, look, I think there's 3 parts to what happened in the last 2 weeks. Okay, first of all, the Fed gave us 50. I think everybody was kind of expecting 25 right up until the last minute. And so it was still an upside surprise. Now, we had written about this. We thought 50 going into the meeting, if they could convey that it was not being done for growth concern reasons, would be a positive. So we got that, checked the box. And I don't think that was a shocker, but it was a positive event. And then we got the China stimulus. But that came in two pieces. Don't forget, right? It came with a monetary stimulus initially. And I would say most people, including us, were like, well, that's interesting, but that's not going to do much. We need fiscal stimulus. They're in deflation, right? We're not going to get any action in the real economy. So then, of course, the policymakers came in because they listened, and they said, okay, we'll do some fiscal too, and then we got this massive move. So we've had a 20% plus move in 3 days, which I would say very few people captured, all right? The other thing you have to think about, why is it up so much today? Well, Japan sold off sharply over the weekend. So I think, China has been a source of funds for the Japan trade, for the India trade, all the other EM countries that have done well. Okay, and now you may see some reversion back, but that feels pretty overcooked to me at this moment. What we care about in the U.S. is the following. Is this going to change the trajectory of growth in the U.S. in a meaningful way? And the answer really is no. Mm-hmm. It can maybe get some excitement in things like materials, some of the industrial stocks who have direct leverage to perhaps a China stimulus of some kind. But beyond that, I think we need to see the labor market get better in the U.S., and we need to see the policy changes from the Fed have an impact on consumers.
Let's talk more about the labor market, because clearly a lot of investors are hinging on Friday's report. How much could that move the needle? And if you have a significant miss to the downside, what would that mean for equities?
I mean, for us, the labor market is everything now. And by the way, it's everything for the Fed.
Yeah.
So, this is the $64 trillion question. Did the Fed cut 50 because they are actually worried about the labor trends, which I think they should be paying attention to that? Or are they doing it because, look, inflation's come down and they're too tight to begin with, and so that they're able to, is the Fed cutting because they can or because they need to? So the labor market will tell us the answer to that. And, we've been pretty straightforward about this. If the unemployment rate goes up again, I think that's a clear negative. If the unemployment rate can come down and jobs data is okay without any major revisions, that would be a positive.
That's where I want to go. And you make that point in your recent research that we need no material downside revisions to the prior months. Unfortunately, for the bulls, we've seen that over and over again the past several months of NFP reports. I mean, when it comes to the quality of the data and these big revisions we still are getting, how much can you really trust it?
Well, even Chair Powell said that, right? He talked about the QCEW revisions being so dramatic. This is what you get in a slowdown. You get revisions to the downside. Just like when you have a recovery, all the revisions are to the upside. So this is not abnormal. And let's take a step back. This is what the Fed was going for when they raised rates. Once again, the big question is, can they arrest the downtrend, stabilize, and then see labor markets actually improve next year? We don't know the answer to that. We're going to get 2 labor reports before the next next Fed meeting. We're going to get election, which I think is probably slowing hiring in the short term, just because there's uncertainty around that. So yeah, it's going to be an interesting October, no question about it.
You also point out that you say earnings revision breadth is the best proxy for company guidance. And what exactly do you mean by earnings revision breadth? It's a little too much jargon for my mom. Hi, Mom.
Yeah.
And, what do you want to see and what is it telling you?
That's by design, Matt. We have these special terms, that only I know the answer. But no, earnings revision breadth is very clear. So it's the leading indicator for earnings revisions. So when I say earnings revisions, I mean are earnings going up or down? And revision breadth we look at because that tends to be a leading indicator for whether it's going to be up or down. Revision breadth has been basically flat now for the S&P 500 for quite a while. And for the Russell 2000 and small caps, it's been negative. That explains a lot of why smaller, low-quality companies have underperformed, because the revision breadth and the earnings revisions subsequently have been poor. So now here's the thing for October. Typically, seasonally, revision breadth is negative going into third quarter earnings. Why? Because fourth quarter estimates are always too high. That's why stocks tend to not trade great in the first half of October. So we'll see if that pattern is, changed. If we get positive revisions in the next 2 weeks, boy, that's going to be a real big positive, because that would be going against the seasonal trend. I expect them to be negative. The question is, will the market care? Because that's normal. We'll see. It's going to be, once again, a very idiosyncratic earnings season like it has been the last 2 or 3.
Well, that leads me to the question. We hit 42 record closing highs in the S&P 500 last week, Friday, and to today you have seen a cooling of that upward trajectory. Is there any more upside left in the S&P 500 for the rest of the year once election volatility cools up?
I mean, we wrote about this weekend, quite frankly. I mean, this is our bull case, which is that the amount of policy stimulus, okay, has been tremendous, particularly in the U.S., both fiscal and monetary. And that seems to be somewhat coordinated now, not only in the U.S., but also in China now, and other central banks are cutting rates. So that tends to allow multiples to expand further. I would say 3 weeks ago, myself and most of the clients I speak with were in the camp that we would have a tough 4 or 5 weeks into the election, and then you'd get a strong rally into year end. But I'm starting to think maybe it might be more the opposite. We may stay bid into the election, and then I think we get some disappointment post-election on the idea that fiscal's kind of peaked, right, into the election, and also the Fed then isn't fully priced. And then it comes down to the numbers. Can we continue to deliver the numbers that justify the multiple expansion we've already had?
Well, we're going to talk more about politics and the election in the next block. I want to go back to what you were saying about earnings, though, and the earnings breadth revisions. There was a really interesting note out from Torsten Slok over at Apollo this morning saying that 42% of companies in the Russell 2000 have negative earnings. For the S&P 500, for contrast, those big caps, that number is just 6%. So even with these revisions that you're watching so closely and the idea that maybe the Fed could cut more aggressively from here, I mean, how careful do you have to be about where you're picking your spots?
Absolutely. We talked about this last time I was here. Like, we don't hate all small cap stocks, right? I mean, we hate the Russell because it's a low quality. We don't hate it. We think it's a low quality index, and therefore in this kind of environment, that's not the instrument you really want to be long. That doesn't mean there aren't some wonderful small cap stocks within that. And this has been a very high alpha generating environment for a lot of our clients are doing quite well generating alpha this year because there are some very good longs and there are some very good shorts. And I think that's the way we're continuing to approach it, whether we're talking about small, large cap indices or even within sectors. And there we've been very clear. We want to continue to stay up the quality curve. We're not willing to go down the quality curve. We don't think things are cheap enough. We don't think the Fed is far enough ahead of the curve yet to stimulate interest there. That could change if we see the labor data improve.
And Mike, I want to talk to you about the potential impact of a strike along the ports. Of course, you have union workers along East Coast ports and Gulf port coasts threatening to strike starting tomorrow, October 1st. And it seems like there is a lot of daylight between the two sides, to put it mildly. So if we were to see a strike, if we were to see a prolonged strike, how much of an economic impact could that have?
I think it's the second part, what you said. It has to be prolonged. I mean, the good news is that inventory levels are still quite high, kind of across the retail channel. So in some ways, it may provide some relief, potentially, that inventories can come down. Maybe there's some extra pricing here as supplies get short. But if it persists beyond a month or so, then it becomes a real constraint, and the costs start to really build up, and then we have a margin pressure. And for the Fed, I mean, the Fed then has to, if let's say this thing doesn't get negotiated, or it does get negotiated in a way where wage increases are significant, does that factor into 25 or 50 next meeting? So there's a lot of implications here. These are messy situations. I'm not optimistic, unfortunately, that it gets resolved this week. Probably need some more action before the two sides come together. But as I said, I think it's the length of the strike that will then determine the magnitude of the impact.
You're not known for your optimism.
It's not true. Well, I'm generally a half glass full guy, but in this case, I think this is a tough one.
Yeah, well, I was thinking, what impact could this actually have on the markets? An interesting story, politically and economically. But then I remembered what happened when that Evergreen boat got stuck.
That was amazing.
Yeah, in the Suez Canal. And those supply chain reverberations lasted for more than a year.
Sure.
Aston Martin right now, its profit warning is because of supply chain problems more than it is China. Do you expect this could be a real problem at that scale?
Well, sure. I mean, we had the port issues during the pandemic where you couldn't get workers to unload the cargo. Yeah. So it's just one more example of how fragile some of these supply chains have become pre-pandemic, right? We've gone to this just-in-time inventory system, globalization, and manufacturing goods halfway around the world and then shipping them from there. And so, I think this is part of the bigger question. Like, how are companies thinking about managing inventories, managing production, reshoring, et cetera, going forward? This is just one more example of that. And labor costs has been something that's been a real tailwind for 30 years, and maybe we can't be that confident about that anymore.
Well, as you both point out, I mean, we've been through this before. We've seen this movie before, and the argument is out there that companies maybe are a little bit more flexible in their supply chain, so that maybe they know a little bit more how to handle these sort of crises?
Well, here's a question on that note. If you're worried about wages going up being potentially inflationary, if you're worried about inventory shrinking here to this extent that you have to raise prices, then wouldn't both things be inflationary? At the end of the day, do you still worry about the trajectory of inflation when nobody seems to be as worried about it anymore, except maybe if you're Michelle Bowman?
Yeah, I think the inflation situation short term I feel fairly confident about, but I think if we don't have a further, like let's say things reaccelerate here because China's stimulus, which is a surprise, we get perhaps, gas prices continue to come lower, that's helpful, and then the Fed gets really ahead of the curve and they start cutting rates again in a way where people feel optimistic. Well then, yeah, I think then you're going to be back into the other camp. This gets back to our original thesis coming out of the pandemic, which is going to be, we're in sort of these shorter, hotter cycles. We don't have all these tailwinds anymore, these relief valves that we've had for the last 30 years of falling inflation, falling interest rates, falling labor costs, outsourcing of production. And so these are all things that make the supply side of the equation harder to manage. And that creates this boom bust almost in the inflationary cycle. I'm not worried about inflation right now, but I think it's a great question for 2025.
And Mike, just quickly here before we let you go, let's talk a little bit more about the U.S. election. There was an interesting note out from Evercore saying that, well, a century of returns show that united government handily outperforms divided. This time could be different, that in this specific scenario, actually a divided government might be better for markets. And with that in mind and that, history that we have here, how closely are you watching the down ballot races?
I think the congressional election is way more important for markets than the presidential election, okay? And the main reason is because of legislation. I would say that a unified congressional outcome is definitely bad for bond markets. Okay, I'm not so sure about stock markets because you'll probably get more stimulus, which is going to be bad for the fiscal situation, but that may be okay for stocks, right? Because the stock market likes growth. The stock market likes inflation. It's a misunderstood concept, right? People think, oh, inflation is terrible for stocks. Actually, that's not true. When inflation was booming, that's when we had the best breadth in the stock market. That's when the Russell 2000 was doing really well because that's their pricing. That's their nominal GDP growth. That's their nominal revenue growth. So I think, to me, a unified government on the congressional side, you get more stimulus, probably better for stocks than bonds. If rates go up too much, obviously it's not great for stocks.
Mike, great having you, and thanks so much for joining us. Mike Wilson there from Morgan Stanley, Chief U.S. Equity Strategist and CIO.